What happens when I write off $30 million of depreciation? What is the cash effect to the firm? Is there a cash effect to the firm? What does IRS thinks of depreciation? It's a tax deductible expense. So if you have depreciation, that's going to reduce your tax bill. So through its effect on the taxes, depreciation is relevant. Because it creates a tax shield. If the firm, for some reason or another, you knew that it wasn't going to be taxed, for that year, depreciation is completely irrelevant because it doesn't create any tax shield. Okay, how about finance charges? Interest expenses. This is a little bit kind of tricky to think about. Do you guys have any opinion? Should they be relevant? You know, if the firm borrows $100 million to finance the project, they're going to pay, let's say, $5 million a year in interest. That sounds like real cash. Your first instinct is it should be relevant. But what if the firm completely equity finance the project by issuing new shares? There is no interest expense. First of all, the project should not know anything about how it is being financed. Okay? How the firm finances, as far as the project is concerned, project is borrowing money from the firm. Okay? But firm may have used equity financing or interest financing or a combination thereof. Project doesn't care about that. On the other hand, the concept of interest charges are still relevant because at the end of the day, one of the things we're going to do, we're going to apply discounting of the future cash flows, right? And that discount rate is going to be associated with firm's overall cost of financing, which we're going to do in chapter 12, the so-called weighted average cost of capital, or WACC. But the expense itself is not relevant, only through discounting. But when we're generating cash flows, we're not going to worry about the interest charges. Net working capital changes, or fixed asset capital expenses, capital spending is obviously relevant. You know, if you spend $30 million on equipment, you can't ignore that. Changes to net working capital, spending, net working capital is relevant because more often than not, a new project requires firm to invest into inventory / accounts receivable to support the sales. If you're gonna sell $100 million of product that year, you gotta have some inventory on the shelves, right? And a lot of times you're gonna end up selling this stuff on credit, depending upon the product. If you're selling razor blades, that probably is not the case. You're gonna have a lot of inventory. But if you're selling, let's say, machine parts, most of your clients are corporate, and they typically trade on trade credit. And remember, this extra investment into inventory and accounts receivable would not have happened if the project is not accepted. That's why they're relevant. We're going to also look at, by the way, these expenditures, these spending are returned to firm when the project ends. So if your project has a life of 10 years and you spend $10 million to invest in the inventory of an accounts receivable the first year, let's just assume that you kept that level there. When the project is done, all of that inventory is sold and accounts receivables are paid. So you're going to return that money to the firm. You're going to basically essentially pay for the time value of the money. We're going to talk about salvage value of fixed assets. Suppose your firm needed a fleet of cars to support the project. You bought the cars, and 5 years later, what's going to happen? Let's say you spent $20 million on those cars. 5 years later, what can you expect to receive for those cars? It's not going to be 20 million. You probably know it from your own car. But you'll still get something, and that's called salvage value. At the end of project life, firms can get some value for the fixed assets used in the projects, and we will look at the after-tax salvage value. Of course, this is definitely relevant and will be positive cash flow to the firm. Or negative capital spending. This was one of the examples I used to teach my son in second grade the meaning of negative numbers. He said, you spend some money on something, that's positive. When you sell it, that's negative spending or positive revenue. I said, oh, it's just the opposite. All right. Well, with respect to opportunity costs type expenses, they should also be returned to firm at the end of the project's life. So if you use that $10 million worth of land for the project, at the end of the project you think it's going to be worth $12 million. Once you're done with the project, you're going to return that land back to the firm. So it's like a negative opportunity cost. So the way we're going to do it, we're going to calculate cash flow from assets as, and let's abbreviate that, CFFA, as operating cash flow, which is OCF, minus net capital spending, NCS, minus change in net working capital. Or net working capital. And I'm going to be fancy, I'm going to make that D a Greek letter using the symbol font. You know, delta kind of being the universal temporal change. Now, in terms of operating cash flow, in the project evaluation context, is basically net income plus depreciation and net income is equal to net sales minus net costs. And I'm going to tell you what I mean by net. Those are net of side effects. Minus depreciation times 1 minus tax rate. As you can see, depreciation is going to play quite a bit of a role. So we will spend some time on depreciation. There are at least